Hey there, I'm Roger Herring. I am the investor's accountant, and welcome to this segment of Ask Roger. What we're going to do today is we're going to talk about this thing that a lot of my Airbnb clients are starting to ask. They're hearing about a strategy where you use a C corporation. Well, they're getting a little bit confused, so I thought I would explain how this works and when to use a C corp and when not to use a C corp. So, let's talk about the traditional rental property first. You got a house, and you rent the house. And normally what we would do is we would put this in an LLC. And this LLC would be what we call a disregarded entity. That means the money flows right back through to us. It's passive income, and we report it on our 1040. Let's talk Airbnb, because as we all know, Airbnb is not your mama's rental property. Airbnb cash flows like it's on steroids, where a traditional rental throws off phantom loss, meaning it has positive cash flow, but for tax purposes it has a loss. Airbnb most of the time throws off a profit for tax purposes. So, what do we want to do? Well, in many cases, if we can qualify this to be a rental property, we would still want to use this strategy. Here's the problem. A lot of the higher end Airbnbs are not rental properties at all. They become hotels. Well, how do you differentiate? Number one, average stay is less than 7 days. Okay, we know that. But here's the key. Are you providing concierge type services? Meaning, maid service while they're there, clean linens while they're there. Are you providing coffee and a coffee maker? It could be that easy. Are you providing bicycles? This type of thing. If you are, then you don't have a rental property. You have a hotel. And hotels are taxed totally different. You see, a hotel, you're going to have the income tax, plus you're going to have 15.3% self-employment taxes on top of it. So, how do we get around this? There is a way, and it's called a master lease. The way we do this is we set up a separate corporation right up here. And this corporation is a C Corp. Now, what we're going to do, instead of renting our property to a bunch of different individuals through Airbnb, we are going to rent this property to the C Corporation with a master lease. The C Corporation now will list the property through Airbnb, collect the rents, and pay us a rent. So let's just use some round numbers. Let's say that your C Corp is able to rent on average for $8,000 a month. So, we're going to rent to the C Corp for $6,000 a month. Alright? So, $8,000 in, they pay out $6,000. $2,000 stays in. What do we use the $2,000 for? Well, we can have in our master lease that the C Corp has to handle any maintenance under X amount of dollars. Whatever we're going to do is this additional money, we're going to burn it. We're going to spend it. So, we've got $8,000 minus $6,000 in rent minus $2,000 in supplies and repairs a month. That's no tax up here. We flow $5,000 back through as passive income to us. The ordinary income is up here. We spend it all out. We take the rest as a lease payment back to ourselves. The key is, if you're providing services, substantial services that would be provided by a hotel, you are a hotel. And if you try to get away with it just filing Schedule E, if you're ever audited, you're going to get caught. So if you provide services, this is a good fallback to use, the master lease program. If you don't provide any services and you're just renting out the house, guess what? No big deal. You can have it cleaned up at the end. You can still be an investor. But there is a fine line. I strongly suggest that you talk to your trusted tax advisor. So, that's it for today, guys. Until the next time, Roger out.